Among major financial institutions, although they've been turning the cycle from disposing of non-core assets to looking with some appetite at buying new businesses, at the same time they're having to deal with contingency planning for Brexit. The uncertainty about the regime, the regulatory regime that will apply on Brexit, means that they're having to reconfigure their businesses and look at where they're putting particular trading books and people, instead of perhaps focusing on building their businesses inorganically. State-aided banks, where banks have been rescued by national governments, we are seeing increasing pressure to sell those assets or indeed merge them. So the good banks are being sold off. Some of the banks who otherwise wouldn't be especially competitive on their own are being merged by the state backers. At the same time, other subsectors like asset management, we're seeing a lot of pressure to consolidate as technology and regulation come together to require them to increase their scale, which is also a factor driving challenger banks, effectively smaller financial institutions needing to bulk up to compete and deliver economies of scale as against the bigger banks. Some of the areas which have been less busy include market infrastructure, where a number of deals have not been consummated, but there remains a huge volume of potential transactions in the pipe. We're not expecting to see those come to fruition very quickly, but that'll be a slower drive towards merger and acquisition activity, we think, over the next 12 months or so. By contrast, specialty finance is hot. There's a lot of activity in the market, both IPOs and M&A, and we see financial sponsors coming into that area in a way that is probably more acceptable to regulators than maybe buying some of the other more traditional financial assets.